questions back in 2014. But a simpler way to think of Thrivent is it's more like a financial cooperative where all of the members or policyholders are owners of the company. So as such, we are not a stock company, which is really important in that we are not beholden to stockholder interest or profits every 90 days. So we're more like a mutual company in that regard. But I actually like to call Thrivent a mutual plus. The plus being that unlike a mutual, for our not-for-profit tax-exempt fraternal status, we are required by law to give back to our communities. And so as such, we are the country's largest supporter of Habitat for Humanity. And you've very likely seen people out in your communities wearing these Thrivent Live Generously t-shirts that you see here on the screen, out doing community service projects, building homes, doing park cleanups, doing fun runs for different things. And all of those are funded by Thrivent in some way, shape, or form. So all members get actually once a year, you can actually apply to get a $250 gift card that you can use as seed money to. So if you raise money for Alzheimer's or something like that, Alzheimer's awareness, and you do a big fundraiser and you want to fund part of your activity, buy some of the raffle prizes that you're going to have at your auction or something like that. This can be used. So you don't take your $250 and give it right to your cause. It's meant to take your $250 and kind of multiply it and turn it into something bigger. So that's just part of how Thrivent gives back. And I'm not trying to dodge the Christian Common Bond membership question. I get questions usually throughout a presentation on it. But I'm really going to focus on the Common Bond requirement at the end of the presentation because it's one of the last things I want you to leave here with a really good understanding of how to have a conversation about it. So Thrivent has strong ratings from AM Best. We've been named one of the world's most ethical companies for 7 years in a row, and we have one of the highest ratings that you can get from Comdex. So we are the only one of the top 3 highest rated carriers that is available to independent agents like yourselves. New York Life and Northwestern Mutual have similar high ratings, but they are captive only, as you know. So you might be wondering, if you're not too familiar with Thrivent, well, are they new to long-term care? Well, that's kind of a yes and no answer to that one. So Thrivent began as 2 separate fraternals, Aid Association for Lutherans, AAL, and Lutheran Brotherhood. And both of those fraternals began selling long-term care insurance back in 1987. So those 2 companies both sold their own products up until they merged in 2001 when they formed Thrivent Financial. So Thrivent then offered some other carriers long-term care solutions for a few years because they were getting all of their other lines, their life, their annuities, med sups, things like that off the ground. But because we so firmly believed in solving this problem for our members, we re-entered the market with our own product in 2012. So we are now on our 2nd generation of product, this one being launched in 2016. So if you think of it more broadly, Thrivent actually does have the benefit of providing long-term care solutions for our members for over 30 years, but we don't have maybe all of that baggage that comes with some of the missteps that other carriers made during the late 90s and early 2000s on things like pricing, underwriting, lapse assumptions, and stuff like that. And so the question I ask for you when you're, presenting solutions to your clients is, when was the last time your other carriers repriced their product? I know some of our leading competitors are still using 2013 pricing. I've been in long-term care now for 23 years. To me, 7 years of the same pricing, that is forever in long-term care years. So our pricing is on our 2016 product. We believe it's got a lot more of the right assumptions built into our pricing. So AAL was formed in 1902. Lutheran Brotherhood began in 1917. So you're actually working with an insurer whose roots go back over 100 years. So it's a newer name, but it's a long-standing company. So there have been some increases on the old AAL and Lutheran Brotherhood blocks of business, but as you can see here, and as you leave clients in the leave behind materials, these are much smaller than the rate increases that you've seen on business sold by some of those stock-owned companies that were selling during these same time frames. Some of those had high double-digit or even triple-digit increases. These, when we averaged them out across all the states, across the handful of policies that they have done this on, I believe it came out to about 23%, which is very, very modest. There have been no increases, just so you know, on the Thrivent branded products that we launched in 2012. So anything with the Thrivent name on it does not have any rate increases on it. So for health pre-qualification, underwriting, and claims processing, we have teamed with one of the most experienced partners out there, LTC Group, which you're probably very familiar with if you do long-term care on a regular basis, just because they support many of the other leading carriers out there. So with Genworth going on hiatus about a year and a half ago, as you can see, mutuals and fraternals now represent the bulk of traditional long-term care sales. I just want you to kind of understand where we currently sit in the landscape. These are last year's 2019 end-of-year numbers from LIMRA. And as you can see, Thrivent is currently the 6th largest standalone long-term care insurer. And I believe with all the traction we've seen with groups like AIM this year, we are going to be jumping up a couple of rungs on this ladder. So real quick on this slide, I'm going to give you a taste of what we're going to be diving into a little bit more in depth in the next few minutes. But I want to just hit some of the real high points. So if something really jumps out at you, you'll focus in on that when we get to it. So first off, we issue ages 18 to 79. As you know, many other carriers now limit this to ages 40 to 75. We have a 5-year rate guarantee built into every policy. As you know, most carriers no longer offer rate guarantees, or if they do, it might be a 3-year maximum on the standalone side. The elimination period has a built-in shortcut. So instead of being the service days that some actually will do a 1=1, we actually have a shortcut built in. 1 day of care in a week is going to satisfy that entire week towards the elimination period. We offer really robust benefits. I think many people really appreciate this. So we can design plans with up to an 8-year benefit. As you know, many carriers no longer offer anything over 5 years. We can go up to a $15,000 a month maximum instead of the $9,000 or $10,000 you might see elsewhere. And then when it comes to inflation options, we can get really creative. We have what you're more familiar with your regular compounding inflations. Here at Thrivent, we call them automatic inflation benefit options, but these are compounding options of 1%, 2%, 3%, or 5% compound. But we also have a really unique rider. It's called a flexible increase benefit. This one's going to give you a lot more flexibility in your plan design. So we're going to spend a few minutes really diving into that deep so that you understand how that one is a little unique in our industry. We're also on the few places that you can find accelerated payment options for standalone. We offer one of the few 10 pays out there. And then we've got some great riders that you can put on any policy. We have a additional cash benefit rider. We can offer shared care, survivorship, return of premium, and we can add a waiver of home care elimination period rider. So as you'd expect in any modern traditional long-term care policy, Thrivent covers services and care in a variety of settings, including home care, residential facility care, adult daycare, really giving your clients the flexibility to receive the level of care in the location they most prefer. All of these contracts include that 5-year rate guarantee we just discussed. And because we are a fraternal, because our members own our company, that means our product is designed to pay dividends, potentially. So just one note, dividends are not guaranteed. And the dividends, if payable, they're going to be applied on an annual basis. And there's only one dividend option available on the long-term care product, and that is to reduce future premiums. So we don't use the dividend availability really as a selling point. And just because they are newer products yet, the 2012 and 2016 long-term care products have not yet paid dividends. That's not to say they won't. They're fairly new experience on those yet. This contract is intended to be federally tax qualified, and it's designed to be partnership eligible where it's available or filed as such. The product is available in all states except for New York. And just because it's one of the most common questions I get, there are no plans to file in New York at any time soon, unfortunately. We understand there's a great opportunity there. So let's start off talking about some of the built-in features in our policy, and then we'll, after that, tackle some of the optional riders that you can add to really customize a plan for someone. So first off, really important, built-in waiver of premium. Once the elimination period is satisfied, you will no longer have to pay premiums on your policy. Or if you have a couple that applies together and has shared care with us, there's going to be a double waiver of premium. So we're going to waive the premiums for both individuals in that instance, even if only one is receiving benefits at that time. Care coordinator services. Having done this now for 23 years, I think this is one of the most beneficial features in any long-term care policy, but it's probably one of the least talked about. So I always like to bring this up. Care coordinator services are invaluable, especially for family caregivers or people trying to manage your care. They don't know where to turn when you need care. They don't know what services. They're in crisis mode. So care coordinator services are invaluable. So Thrivent has that built into our policy. Now, you don't have to use our care coordinator services in order to use any of your insurance benefits. The expenses for the care coordinator services are not going to be reimbursed from your benefit pool. They're actually covered separately by Thrivent. So this is not going to ding your benefit pool. We so firmly believe in the value that care coordinators bring to families that this is something that Thrivent is going to pay itself. So to help with emerging services and technologies, things that might change as we move along, we keep hearing about things like, moving towards robot care and stuff like that. If those things do happen, an alternate care provision is included in the policy to cover those type of trends. We offer bed reservation in a facility for up to 60 days per calendar year. And we also have a contingent non-forfeiture benefit in the event of any type of substantial premium increase, like we were talking about some of those older policies had that were sold back in the 80s. So now let's talk about ancillary benefits. These are, again, included in all contracts, and they cover things like respite care, equipment and home modification, caregiver training, and an international care benefit. These ancillary benefits do not satisfy your elimination period if you're using them. And the ancillary benefits that are paid are going to come out of your total benefit pool amount. But each one of these ancillary benefits has its own separate benefit limit, and each one of those is going to be equal to 2 times whatever your maximum monthly benefit is at the time that you go on claim. So it's not 2 months worth of benefit for all of these. Each one of these has the equivalent of 2 months worth of benefit. So it's 2 months for respite care, 2 months for equipment and home modification, et cetera. And the reason I bring that up in particular is when we get to international care, because we'll cover up to 2 months worth of benefit in any countries where it would not violate UN sanctions or any US treaties. But with only 2 months of benefits, if international care is a primary concern for your clients, I'd like to be really upfront and admit it, Thrivent might not be the best fit. I know other carriers might go up to a year for international care. So if that is extremely important to somebody, we can offer a limited benefit there, but we might not be your best fit. So next, let's talk about some basic building blocks in any long-term care policy, all those decisions that you have to make no matter what product you're selling. Again, I bring these up because these are some areas where Thrivent differentiates from our competitors. So first off, elimination period options. We do 30, 90, or 180 days. And instead of the actual service days that some plans offer with Thrivent, if you just have that 1 day of care in a week, it's going to satisfy that entire week towards your elimination period. And we'll discuss in a little bit the rider that you can make it a 0 day for home care. Maximum monthly benefit, again, we can do some really robust plan design here. Instead of capping out at $9,000 or $10,000, we can go up to $15,000 a month in $100 increments. Benefit multiplier, we can do 2, 3, 4, 5, and 8-year benefits. And you can actually add shared care to any of those. So I'll probably say this a couple times, but taking 2 8-year policies and tying them together to create a 16-year shared pool, it's probably the next best thing to an unlimited benefit these days. So now let's talk about some of the optional riders. When it comes to designing a policy that's going to increase to keep up with cost of care, we have two different options. Again, we have the annual increase benefit that we'll discuss in just a bit. This is what you're probably most familiar with if you sell long-term care. This is your regular compounding inflation of 1, 2, 3, or 5%. And then we also have a flexible increase benefit. So the flexible increase benefit, or FIB, is available to applicants ages 18 to 70. And what it's going to do is that it's going to give you an opportunity to increase your maximum monthly benefit and whatever is left in your total benefit pool on your contract anniversary by 5% compounded annually. And what it is, it's an all or nothing buy-up offer each year that does not require evidence of insurability at that time. Now, the increase will be automatic on your contract anniversary unless the insured opts out. So they don't have to remember to do this and opt in. If they don't want to take an increase in any given year, they opt out when they receive their annual notification letter. So the premiums, they will increase anytime somebody accepts one of those offers, and each of those little increases is going to be based on the insured's age at the time of that increase. So you might buy a policy at age 50, and then at age 53, you take one of these offers. Well, you're going to have most of your policy priced at the age 50, but you're going to have that 5% compound, that little bit added on at age 53. So if you chose that 5% buy-up every single year, it's going to be a lot more expensive in the long run than if you had just went with a traditional 5% compound that we can also do, because each of these little increases here is based on your age at the time of the increase that you're taking. So the automatic increases, these will occur if the insured is on claim, and I'll show you why that becomes really important. Now, you might be wondering, what are the rules around this? Well, if 3 consecutive offers are declined, at that point, no future increase offers will be extended. However, if that happens, the rider is still going to remain on your contract because the insured is still going to be eligible for any automatic increases that could occur if they are on claim. And you're going to see how that plays out here on the next slide. So let's walk through a hypothetical scenario. We have a client named Mary. She was 50 years old when she bought a Thrivent contract, and she chose the optional FIB rider because it helped her manage her budget, because the premiums, the increases, were going to be dependent on her choice on accepting or declining an offer. And for her, this was really important because it was going to be during some years that she knew her children were going to need help paying for college. But because of family experience, Mary also knew that in order to be prepared for the future, she wanted the maximum monthly benefit amount to increase over time. And her initial goal when she bought the policy was to accept increases whenever she could until her benefit amount reached at least a $15,000 a month benefit. She thought that would be okay for her. So over the next 20 years, Mary accepts 13 annual increase offers. They're in the dark red on the left. And she declines 7 in the dark gray. However, as you can see, she didn't decline the offer in 3 consecutive years for a while, so that meant she continued to get those FIB offers each year. Jump to the middle of the chart, and you see at age 70, Mary now takes a look at her financial situation, and she decides her maximum monthly benefit is now at about that $15,000 a month level. And she still believes that this is going to be adequate to meet her needs. And so at this point, she declines all future increases. So there you see 3 dark gray bars in a row. She has 3 consecutive declines. At this point, Mary is not offered any future increases. Jump forward a few more years, age 80. Unfortunately, Mary has some health issues, needs to file a long-term care claim. Well, at this point, the FIB kicks back on, increasing her maximum monthly benefit and whatever is left in her benefit pool by 5% compounded annually, and it will continue to do so each year while she is receiving care. That's why you see after age 80, it starts ticking up in red again. But Mary doesn't have to worry about paying premiums or the cost of any of those increases either, because the waiver of premium is a standard benefit included in her insurance. So this can help her policy last longer just because she's on claim and it's going to continue to grow. And in the illustration software, you can actually show how the pricing would play out based on a client's desire. So if somebody said, okay, I want to take it only every other year, every third year, I want to take it every year up through a certain age, you can really dial it in to meet even an engineer's analytical desires. So the FIB option, this can be partnership qualified depending on age in 26 states, as long as you meet the buy-up requirements from that state. And they do vary from state to state. And the team at AIM is going to have a full list of all the partnership requirements for all the states as a follow-up to this call that they can provide. But one example might be here in Minnesota, we require that someone accept all FIB offers up through age 75. So in that example, Mary's policy, as you can see, it would have lost partnership qualification after she declined her first offer at age 57. So it's a good solution for those who have annual reviews with your clients, because you want to make sure that they understand the need to continue buying up to maintain a partnership status or to just keep growing their benefits. So this is very popular with Thrivent's career network itself, because they are having those annual meetings with people and they have this annual discussion. So it's one of their favorites. But what I'm finding is resonating more with most producers and actually most consumers is what you're probably most familiar with, which again is your traditional compounding inflation options. Again, we call it annual increase benefits. Here, your monthly benefit, your total pool of money, any of those ancillary benefits are all going to increase annually on your rider anniversary by whatever percent you choose. The difference here being the premiums are going to remain level over time. And that's because the cost of all of those future increases is automatically built into the premium. So as a result, this benefit might be more appropriate for people who just want the convenience of making one decision and not having to decide each year what they want to do, or people that just prefer a level premium for budgeting purposes. And so again, we have 4 different choices you can go with. We have 1%, 2%, 3%, and 5% compound. And an important note, the 1% and 2% compound inflation options are considered partnership qualified, again, depending on age, in over 20 states. And so what this will do is it'll help you make partnership coverage be a lot more affordable for some people, as we found premiums to be about 1/3 less expensive by dropping to a 1% inflation if you have to. And again, we'll have that full list of partnership requirements for all states so that you know what your state's requirements are. Other items to note, Thrivent was the first carrier to launch partnership policies in Illinois and New Mexico. And I do like to call out, just because I get this question a lot, while we do offer a product in California, it is not a California partnership product at this time. So now optional riders. Here, if I mention some cost percentages, please note that these can be impacted by various factors. So these are going to be ballparks, but they can be impacted by various factors, things like elimination period, marital status, risk class, things like that. So first off, we have an additional cash benefit rider. This is going to add flexibility to pay for services not typically covered, or to help with things like informal caregiving, maybe family caregivers, things like that. So this is not a cash alternate option like some carriers offer, where you're either getting your full reimbursement or you're getting your cash, part of that as cash instead in any given month. Here, you're going to receive up to 100% of your benefit as reimbursement, plus you'll receive an additional cash benefit to help cover those other expenses. And the use of the cash benefit does not draw down your total benefit pool quicker, because this is an additional cash benefit. So if you have a $200,000 benefit, let's say, it's not going to take extra out of that. Your cash benefit is a separate benefit being paid on top of that. So the way it works is it's going to equal part of whatever your maximum monthly benefit is that you're receiving at the time. So if you're receiving home care services, you will receive an additional 15% of your maximum monthly benefit paid as cash. Or if you're receiving facility care, the cash benefit is equal to 10% of your maximum monthly benefit. And the cost of adding this additional cash benefit rider runs about 16%. So your clients don't want to use it or lose it. Very common scenario, and why a lot of people now turn to things like linked benefit plans. Well, we can design things to compete against that. So first off, we have a non-forfeiture rider available that's going to provide a paid-up benefit equal to whatever premiums that somebody has paid in to the point that they decide to terminate their coverage. Here, the contract has to be enforced for a minimum of 3 years before the benefit can be triggered, and the cost of adding this is going to run you about 8%. There is a return of premium upon death rider that's going to return any premiums paid to the insured's estate at the time of death minus any claims paid. Now, the rider must be enforced for 10 years before death occurs to be eligible for premium. And because of that stipulation, we find that our return of premium tends to be one of the most affordable in the market. So the cost of the return of premium, it does vary with issue age, but a couple of examples, it runs about 25% for somebody age 50 to 49% for somebody age 65. And again, because it's priced to trigger only if it's enforced for 10 or more years, it is going to be a very affordable return of premium option for traditional carriers. So you have couples applying together. What are some riders that we can add here? Well, first off, shared care rider. It's going to link 2 individual contracts together into a one pool. So it's not a third pool option like I know some carriers offer. Again, this is going to give them all kinds of flexibility, provide couples with that flexibility in how they receive their care. If the insured uses his or her entire available benefit, then he or she can start drawing from their partner's benefit pool. So again, if you couple shared care with an 8-year benefit each, you have a 16-year shared pool, probably the next best thing to an unlimited benefit. There's not a lot of options out there for unlimited benefit, and of those that do exist, they are fairly spendy. So if that's important to somebody, 16 years, most couples are not going to burn through a 16-year shared pool. So what happens if one spouse uses all of their benefit, uses all of the healthy spouse's benefit? Well, if that happens, the healthy spouse can elect to purchase a 2-year benefit for his or her use only. If that is something that needs to be explored, no evidence of insurability is going to be required for them to do this. But the new premium is going to be based on the insured's attained age at whatever time this happens. And this is going to be available as an option for somebody up through age 85. And the reason for that is because we know a lot of people might go on claim in the late 70s or early 80s, and we don't want one burning through all of both pools and then the other spouse now being mid 80s and not having anything if they need care. So they can buy up to a 2-year, they can buy a 2-year benefit that only they are going to be able to access. So what happens if one of them dies? The surviving benefit partner's contract is going to be increased by whatever is in the deceased person's pool. The cost of the shared care rider, though, is then going to be dropped from the policies, but the spousal discount is going to remain in place for the survivor. Now, the cost of shared care, this one does vary with benefit multiplier, but just a couple of examples. It runs about 25% to link together 2 3-year plans, to about 16% to link together 2 5-year plans. We also offer a survivorship benefit, a rider, where if the couple both have in-force contracts, both have this rider for 10 years, one of them dies, the survivor's contract becomes fully paid up, and the cost of adding survivorship runs about 10%. So if your clients want to make it easier for their future caregivers, they might consider adding a 0-day elimination period for home care by adding the waiver of elimination period for home care and adult daycare rider. Any days received under this benefit will be applied towards meeting the elimination period. So if they need to go into facility care next, the elimination period doesn't have to start over. And we believe we offer one of the most affordable 0 days out there by charging about 7% for this rider. I know some of the others might offer this, but it costs usually about 9 or 10% additional premium. So just a couple little areas where we can differentiate when you're comparing things apples to apples. So again, Thrivent is one of the only carriers currently offering a 10-pay option. So your clients, they can pay up their premiums in 10 equal payments. If you go this route, just know there is a reduction in commission for you, the agent. And this is not going to be available with things like the FIB rider because of that changing every year potentially, or with things like the survivorship rider. Now, Thrivent doesn't want to become a 10-pay only shop. So our actuaries wish for this to only account for about 10% or less of our business. And right now that number is actually running about 5% of all Thrivent business. So there is room for growth. However, because of that wish to keep this amount of our risk limited, Thrivent does have a technicality or limitation here that I'll explain. So anytime you have 3 or more people being submitted for 10 pays at the same time, so not like 3 people over the course of several months, all completely unrelated. I'm talking more like you have a small family-owned business where everybody's going to meet that Christian Common Bond requirement, and they're all applying with 10 pays because they want to pay it through the business in 10 years. In those kind of instances, Thrivent does want to pre-approve those cases. Just for your reference, I'm saying this is pretty much a technicality because in the 5 years we've been doing this now with independent brokers, they have yet to deny any of those requests. But we do have this formality in place if submitting a bunch of related 10 pays. Again, any one-off 10 pays or a couple applying together for 10 pays, no pre-authorization is needed. And really all you do is you shoot us an email in those 10-pay authorization scenarios saying, I have this group of 5 family members are all applying together, and here's what the quote looks like, and here's what I'd like to do, and we'll get you the authorization. So now let's talk about potential discounts. So people who qualify for the preferred health discount are going to receive a 10% discount. However, with only 25 to 30% of our policies currently being issued preferred, as a producer, standard should always be your standard when quoting if you're unsure. As you know, it's always way easier to go back and tell somebody they were so healthy they get a discount than to go back and ask them for more money, right? We do have 2 types of couples discounts. Oh, before I jump forward too, we do have a great preferred health checklist in our underwriting guide too. So you can get a really good indication before going into a sale and if somebody's going to get that discount or not. We can also pre-qualify any case with LTCG, so you can bounce that off of their underwriters and know if somebody's going to be a preferred issue, standard, or we actually do have 2 substandard categories, a class 1 and class 2 as well. So couples discount, we offer a 20% couples discount for a couple where both apply and are approved for coverage, or if one individual already has existing coverage that was either issued by Thrivent or by one of those predecessor fraternals I mentioned earlier, AAL or Lutheran Brotherhood, and the other person now wants to apply for Thrivent coverage. So in those instances, the new applicant would get that 20% couples discount. A 5% discount is available if both individuals apply, or if only one is approved for coverage, or if just one person in a couple applies. So you might be wondering who qualifies for the couples discount. Thrivent considers any married couples, civil unions, domestic partners, people named in a valid certificate or licensed by the state. If you're wondering, do they consider same-sex couples? Yes, Thrivent does. Also, anytime you have 2 individuals who are living together for at least 3 years in a committed relationship as partners or family members and are committed to sharing expenses, are not married, or if they're related, they have to belong to the same generation. So where I often see that is if you have here in the Midwest anyway, we oftentimes have 2 bachelor farmer brothers living together on the family homestead that they took over after mom and dad retired. They're living together. They are sharing expenses, of course, not married, and they're of the same generation. Well, those two brothers could qualify for the couple's discount if they wanted to purchase long-term care together. So let's talk about some sweet spots. Where does Thrivent fit? Singles, especially men, were very competitive. And that's, for men, it's pretty much across the board. We can be very competitive. Again, because it's priced to only pay out if in force for 10 or more years, that return of premium can be very affordable. Younger couples, because we can, first off, insure younger people that others won't touch. But younger couples were very competitive. High net worth clients, affluent people, whatever you want to refer to them as. And the reason I bring that up is what they find the value in is those more robust benefits, that higher monthly benefit available and the longer benefit period that than others might. I mean, you can design something. You can do the 8-year shared care, so a 16-year benefit. You can design it up to $15,000 a month. You can go your old school 5% compound on it. I mean, it's not going to be a cheap policy, but for somebody that wants the best of something, you can give them one of the most robust plans here available. For somebody that wants the best, you can give them the best. If you're looking at things apples to apples, comparing against other carriers using a tool like StratDecision or something like that, we're very competitive at the 5-year benefits. Can pay. Anytime carrier strength is important, we should be a go-to for you. And now I'm going to go off script from my slides, and I'm going to talk about some underwriting niches that our team has discovered. And I'll get a list of these to the team at AIM to share with you, but I'm not able to share them in this slide. So this is all going to be verbal for the next minute or two because I was not able to get these approved by our compliance team. But these are a few areas that we have discovered. And just note, these are generalities and are going to vary based on other health issues. So these notes are not absolute, and the underwriting guide or our producer guide or the pre-qualification hotline should always be consulted. But these are some areas where we are competitive. So first off, again, because there's that preferred health checklist in the underwriting guide, we can give you a really clear indication of if somebody's going to get preferred issue or not. Not everybody offers that in their guides. And then according to the Brokers World Long-Term Care Survey that just came out the first week of July, I took a look at that, and it shows actually that Thrivent issues about 4% more cases at preferred than the leading competitor on standalone. I'm not going to name that carrier, but you know who I'm talking about. So Thrivent will issue more at preferred according to Broker World Magazine. You can take a look at that. I can get you the links to that. Thrivent will take a look at history of severe anxiety or depression based on stability. We'll take a look at conditions like arthritis, AFib, or heart bypass, depending on residual effects and stability. We can be very, very favorable on those conditions. We'll look at a variety of cancers based on stage, treatment, and stability. But one example I'd like to share is we will consider someone who is recovered and treatment-free that's had stage 4 Hodgkin's. I know a lot of carriers will decline that. Crohn's is something that Thrivent will consider, whether it's single or multiple flares. Type 2 diabetes. With Thrivent, A1C can go up to 8.5. So what Thrivent is looking for is stability of meds or insulin. So they don't actually list a maximum number of units for insulin. So if somebody is using insulin, you do want to discuss quantity, stability, all the factors that you know with the pre-qualification line for guidance. Here's a big one. Does family history matter? Thrivent doesn't penalize or auto-decline based on a family history of cognitive issues. So if parents or siblings have dementia or other cognitive issues, take a look at Thrivent. I know that can be a huge issue with other carriers that you're either going to get a very limited policy if issued at all, or you're going to be declined based on your family's history of cognitive issues. We underwrite you based on you. Thrivent also won't automatically decline based on another carrier declining you. So we will take a look at someone that may have been declined by one of our peers. Now, that being said, we're not going to just take any decline. So any past a client that you have somewhere else, you would want to run all of the information that you have by that pre-qualification line before submitting an app. They'll give you a really good idea of if we'll take a look at them or not. But I've seen many policies get issued with Thrivent that were not elsewhere. So last and certainly not least, Thrivent is continuing to accept applications at all of its pre-COVID issue ages of 18 to 79. So I know while other carriers may have stopped issuing, for example, ages 65 and older due to face-to-face assessment requirements, Thrivent has been issuing up to age 79 in all states that we are in. So even with other carriers now lifting those restrictions in many states, I know right off the top of my head, there's still 13 states where Thrivent should be a go-to for you. So if you're in California, Kentucky, Maine, Minnesota, New Hampshire, New Mexico, North Carolina, Ohio, Oregon, Pennsylvania, Vermont, Virginia, or Washington State, and you have somebody that is 65 or older, we can work with you. So here's how Thrivent has been handling face-to-face. So for clients who are under age 70, no face-to-face interview is going to be required, provided that the client has seen a doctor and had labs done in the past 2 years. And we actually have a really great brochure that lays out all the age-required scenarios here. Face-to-face assessments are required for anyone 70 or older or by underwriter discretion. And if face-to-face interviews are required, Thrivent is not waiving that requirement just because of COVID-19. So if the applicant is unwilling to complete the face-to-face because of concerns about somebody coming into their house, well, then, of course, the application cannot proceed. But so far, looking at, there were concerns that people might not be able to find examiners to go in and conduct an interview if it was needed. There haven't been any areas in the country, after I talked to a long-term care group last week, they haven't had any experiences any place in the country where they could not find an examiner who was able to go in and conduct the assessment for somebody. So we've been just chugging right along while others may have had to be on the sidelines for a bit. So we do understand some applicants have those concerns about face-to-face assessments right now, which we totally get. So that age-based requirement should be discussed with them prior to applying, and use that what to expect brochure to have a really good conversation with them so they understand the expectations. So what are some other areas you should look at Thrivent? 1035 exchanges for somebody wanting to fund their policy using existing life insurance or annuities. We've got a frequently asked questions piece that I can get to everyone on how we will work with 1035 exchanges. Since Thrivent has nationwide pricing, not state-specific pricing, we can be a lot more competitive in states like Florida or California, where other carriers may have state-specific pricing. Another really unique thing about Thrivent is we allow you to increase or decrease many of the benefits after issue. So while most carriers will allow you to remove riders or decrease benefits after issue, with Thrivent, we can actually increase or add things after issue. It's going to require evidence of insurability at your attained age, but some things that you can take a look at. And again, these might be things down the road that somebody could benefit from if they have a family experience that they now relook at their own, take a relook at their own policy, and they say, okay, Dad needed care for 4 years and I only bought a 3-year benefit. What should we do now? Here's some of the things where we can make adjustments. So elimination period with Thrivent. We can either do a longer or shorter elimination period. Benefit multiplier. We can decrease or increase that. The maximum monthly benefit, you can decrease or increase that amount. Your automatic inflation, those compounding inflations, you can decrease or increase those. Waiver of elimination period for home care, you can either drop or add that rider. Cash benefit rider, you can drop or add that. So it's a really unique thing in that we can add some of these things after issue and years down the road after issue if somebody is going to be insurable. Not everyone does that. So now you want to know, how much does Thrivent cost? Well, Thrivent's quote software is going to be available to you through AIM. It is part of our e-app, and it's going to allow you to do most of the entry actually from one screen, so you don't have to toggle back and forth through multiple screens. We actually have a cost of care tool that is built in, so if you do a lot of screen share selling, you don't have to have that minimized at the bottom of your screen in a different tool and then jump back and forth. You can actually do that right here from this tool. Thrivent software also allows you to show the impact that different changes in the FIB inflation might have on future premiums. So I mentioned earlier, if somebody decided to select a buy-up every third year, you can show your client what that would look like for their premiums, as well as how it would impact their benefit pool. Also included in this software is a function that shows how future dividends could offset premiums. So again, dividends are not guaranteed, but if you showed them this and they wanted to see, okay, well, what if dividends started paying out at when I'm in my 60s? Here you can show how that scenario might actually, their annual premium, you take the dividend and their actual premium outlay are going to be different. You can show somebody how that could impact their premiums down the road. Again, those dividends are not going to be guaranteed, but some people are understanding how that could help them out down the road. So for those already using iPipeline's iGo platform for other lines of business, you're going to appreciate that Thrivent's eApp is built on a really user-friendly platform you're already familiar with. We do have a different iGo access that you would be using with AIM to get at this, but it works the same as others that you might use, and it's just going to do all the things that an eApp does with any other product. It's going to eliminate any of those not in good order apps, reduce your cycle time, give your consumer that faster and better consumer experience. They're not having to worry about things getting lost in the mail, and it's just a reduction in follow-up meetings with the client. So now I'm going to finish off with our two biggest questions. Second biggest question is always, how does Thrivent compete on price? Well, I mentioned some niches where you can take a look at us. And when you're competing against the cheapest products on the market, while we can be competitive, where we really shine is if instead the conversation is about company strength. Again, I always mention cheapest product isn't necessarily always going to be the cheapest if they're underpriced right now. So when was your other carrier last repriced? So in this scenario, instead of looking at just what is the cheapest thing out there, I took a look at the top 4 highest rated traditional carriers. And so we ran only A++ rated insurers, or those with Comdex scores of 98 or higher. And as you can see, we have 2 that are available through captive distribution only, Northwest Mutual and New York Life, and then 2 recently made available to independent producers, Mass Mutual and Thrivent. And I tried to look at everything apples to apples, but what I actually did with Thrivent is I added in some things that are not available with the others, like a 0-day home care and the shared care, because those things are not available with all these others. And when you take a look at that, you actually see you get quite a bit more bang for your buck with Thrivent when you're competing against the strongest carriers in our industry. So now the biggest question. What about the Christian thing, Craig? All right, so as we discussed, Thrivent is a fraternal organization that serves Christians. So very important here, I just want to make it very crystal clear. We are not a religious institution selling financial products. We are a financial institution that serves Christian members. Very important distinction. So as such, though, because we require somebody to be a member, to be part of a fraternal, there is one and only one Christian-related question on the application. And it's actually one of the very first questions on the e-app. It's one of the very first questions in the PDF versions of the apps, so that people don't get all the way through before knowing whether they qualify or not. And the question is actually very, very simple. It's just this on the screen. Select one of the following. I am a Christian seeking to live out my faith, or I am the spouse of a Christian who seeks to live out his or her faith. So that's it. No questions about what church someone goes to or how often or if ever. And because of how they've worded the question, you can actually have people from mixed faith marriages or even people without faith get coverage with Thrivent as long as they are married to a Christian living out their faith. And I always get a question, well, what do they do to check up on this? Do they check anything when you apply or at claim time? They do not. This is an honor-based, an honor system kind of question. So as long as you're able to truthfully answer those questions, Thrivent goes with it. And with a national survey recently showing, I believe it was Pew Foundation that did this, that about 70% of the American population self-identifies as Christian, odds are many of the clients that you work with would be eligible to apply for Thrivent coverage. So how do you position this with your clients, especially if you're unsure of somebody's faith, you don't want to offend anybody? So we've been using this approach now for the last 4.5 years, and it works. It tees up Thrivent by putting your client in charge of whether you can proceed with the solution or not. And the way you do that is, it's really simple again. You simply say, I have a few different solutions that I'd like to discuss today. One is from a fraternal benefit organization, an insurance company called Thrivent. So they are a top-rated financial services organization that was formed to serve Christians. So I don't know if that's an option for you, and if not, you know what, that's okay, because I have a couple other products we can discuss. At that point, stop talking. They will let you know whether you can proceed, or they're going to say something like, you know what, that's not for me. What else do you have? And you move on. So it's actually the common bond thing. I find producers kind of get hung up on it. They try to go into it too deep. They try to make it more complicated than it actually is. It's that real simple question and a real simple way to present it if you're unsure. Don't get into any deep theological discussions. Don't start talking about, this church versus that church, because when it comes to Christianity, it's almost like Baskin Robbins. There are so many different flavors, and they all differ a little bit here and there. From Catholics to Methodists to Presbyterians to Lutherans to Baptists. I mean, there's so many minor differences across the board. Don't get into that discussion. Do that after they've signed the app and they're insured with Thrivent, because that's a completely different conversation. So on a related note, while you do have to be Christian or married to want to buy Thrivent's product, you do not have to be Christian to sell our long-term care product. So to help you get started with Thrivent, because I know many of you are very set in your ways, or you're very comfortable with some of the solutions that you already have, we put together an incentive. We've been seeing some really great traction with some producers from AIM. And so we've actually extended a launch incentive that we had kicked off back in June. So actually any applications that are submitted between June 15th and the beginning of October, and that are enforced by the 1st of December, you will receive an extra $250 per life if that policy is enforced and paid by December 1st. So there is no cap to this incentive. So if you have a couple applying together, both of them are issued and enforced, that's an extra $500 for providing the same Thrivent solution that you would have provided otherwise. So you can really rack up extra cash here. We think this is one of the most generous incentives that has been in our industry for years. And it's just because we want you to give us a test drive. Kick the tires a little bit, take us for a spin around the block, see what you think of us as a product and our service. Just give us a test. We just want a spot at the table. We're not looking to usurp anybody's dominance in our industry at this point. So I hope I've shared a great story with you today. As I mentioned, there's no better time than right now to be adding Thrivent as an option, both because of some of the underwriting areas that we can be a little bit more flexible in, also because Thrivent is going to be everywhere for the next 6 months as far as advertising goes. We're a benefit-rich solution from a financially strong and stable fraternal insurer. And the cool thing about it is policyholders genuinely feel good about the company that they purchased from, because they see that the company they bought from and that they're a part of is out doing good in their community. So with that being said, contact the team at AIM to get started. And with that, I'll throw it back over to you, Don.
Thanks, Craig. I know it was a little long, but it was very good information. And like you said, Thrivent is a great company, and we've already written a lot of business, and plan to write a lot more. The only question I really had was with the shared care feature, how much do they have to leave if they have to dip into that? I couldn't remember if we touched on that.
No, you can use up everything in both pools. If that happens, then the healthy spouse who hasn't used anything, they have that option to go buy a 2-year benefit that's just going to be for their use only. So somebody could burn through an entire 16-year bucket if they needed it.
Okay, that's kind of what I thought. I just wanted to make sure of it, you know. So,
yep.
We're going to open it up for questions now. We'll unmute everybody just to see if there are any questions out there. There is one in the queue. I don't know if you can see that, Craig, or not.
I can't, no.
Let's see. Well, it talks about MedSup. Are there any discounts or benefits if someone is on the Thrivent MedSup product?
No, there's no discount for owning one of the other products.
Okay. So we'll unmute everybody and just kind of see here. Looks like Avion is unmuted. We'll just see if we have any questions. Otherwise, we'll move on for the day.
Yeah, the only other thing I guess I would throw in that I didn't have part of the conversation today, but I know it's becoming more and more frequently asked by people is how does Thrivent consider somebody with a COVID diagnosis? So if you do test positive, you are going to have 3 months of stability once you are shown to no longer have COVID-19 before you can apply.
Okay. I'm not hearing any questions. Craig, we appreciate your time.
No problem. If anyone has questions, send them to Don, and I know that the team over at AIM has gotten really familiar with our product in the past couple of months, and if he can't answer the questions, he can get them to me, and we can answer those for you. But thank you so much for your time, everyone. I greatly appreciate it.
You're very welcome. The one other thing is we will be reaching out here. Michael or Mike Anderson or myself will be reaching out to you after this webinar today or tomorrow to just touch base to see if you had any other questions. So everyone, thank you very much for being on our webinar today.